President Trump's ongoing criticism of the Federal Reserve, particularly regarding its interest rate decisions and even its building renovation project, is generating significant unease in the global economic landscape. This rhetoric directly challenges the long-standing principle of central bank independence, which asserts that monetary policy should be free from political influence. The Federal Reserve, like many central banks worldwide, operates with a dual mandate: to maximize employment and maintain price stability, control inflation. To achieve these, it adjusts interest rates and manages the money supply. Political interference, however, can pressure central banks to prioritize short-term gains, such as stimulating economic growth before an election, over long-term stability and inflation control. History shows that when central banks succumb to such pressure, it can lead to unchecked inflation and economic instability. Investors and economists are expressing serious concerns because a politically compromised Fed could lose credibility. This erosion of trust can lead to higher long-term interest rates, as bond investors demand greater compensation for perceived risks, making borrowing more expensive for businesses and consumers. Such an environment can hinder investment, slow job growth, and potentially trigger financial market volatility. While Trump's immediate focus often appears to be on lower rates to boost the economy, experts warn that an overly aggressive rate cut could reignite inflation, which remains a persistent concern. The global economy is interconnected, and the stability of the U.S. financial system, underpinned by the Fed's independence, has ripple effects worldwide. Any perceived weakening of this independence could lead to a less stable global financial environment, impacting currency values, international trade, and investment flows. The ongoing tension between President Trump and the Federal Reserve stems from several key reasons, largely centered on monetary policy decisions and the fundamental principle of central bank independence. Interest rate disagreement. Trump has consistently advocated for lower interest rates, believing they stimulate economic growth, boost the stock market, and make borrowing cheaper for businesses and consumers. He has publicly criticized the Fed, and specifically Chair Jerome Powell, for raising rates during his previous term and for not cutting them more aggressively, arguing it hindered economic expansion. The Fed, on the other hand, operates with a dual mandate of maximum employment and price stability. Raising rates is often a tool to combat inflation, which the Fed aims to keep in check to ensure long-term economic health. This divergence in priorities is a primary source of friction, erosion of credibility and independence. The core concern among economists and investors is that Trump's rhetoric undermines the Fed's independence. This independence is crucial because it allows the central bank to make decisions based on economic data and its long-term mandate, free from short-term political pressures. When a central bank's independence is questioned, it can reduce credibility. Markets may doubt the Fed's commitment to its inflation target, leading to higher inflation expectations and thus higher interest rates for borrowers. Increased market volatility. Uncertainty about future monetary policy can cause instability in financial markets, impacting investments and economic planning. Risk inflationary policies. A politically influenced Fed might be pressured to juice the economy before elections, leading to unchecked inflation, as seen in historical examples like the Nixon administration's pressure on the Fed in the early 1970s. Long-term economic stability. Central bank independence is broadly recognized as vital for long-term economic stability. By insulating monetary policy from immediate political cycles, central banks can focus on sustainable growth and price stability, which ultimately benefits everyone. Trump's challenges, therefore, are seen as a threat to this established framework, risking a return to periods of higher inflation and less predictable economic conditions. The challenge to central bank independence, such as that seen with President Trump's rhetoric towards the Federal Reserve, carries several significant consequences for both domestic and global economies. Increased inflation. One of the most direct and widely recognized consequences is the risk of higher inflation. When a central bank is pressured to keep interest rates artificially low to stimulate short-term growth or finance government spending, it can lead to an excessive supply of money in the economy. This imbalance between money and available goods and services typically results in rising prices, eroding purchasing power, and making goods and services more expensive for consumers and businesses. Historical examples, like the US in the 1970s under President Nixon's pressure on the Fed, demonstrate how political interference can contribute to prolonged periods of high inflation. Erosion of credibility and trust. A central bank's credibility is its most vital asset. When political leaders frequently criticize or attempt to influence its decisions, it undermines public and market trust in the central bank's ability to act independently and in the long-term best interest of the economy. This erosion of credibility can lead to unanchored inflation expectations. If people believe the central bank won't keep inflation in check, they may demand higher wages, and businesses might raise prices preemptively, creating a self-fulfilling prophecy of rising inflation. Market volatility. Investors react negatively to uncertainty. Doubts about monetary policy stability can lead to sharp swings in financial markets, impacting stock prices, bond yields, and currency values. Higher borrowing costs. Paradoxically, attempts to force lower interest rates can backfire. If markets perceive that a central bank is losing its independence and might pursue inflationary policies, they will demand a higher premium for lending money. This means long-term interest rates on bonds, mortgages, and business loans could actually increase, making it more expensive for governments, businesses, and individuals to borrow, ultimately stifling investment and economic growth. Reduced policy effectiveness. An independent central bank can use its tools, like interest rate adjustments, effectively to manage economic cycles. If its decisions are constantly second-guessed or overruled by political figures, its ability to respond appropriately to economic downturns or inflationary pressures is severely hampered. This can lead to delayed or inadequate policy responses, exacerbating economic problems rather than mitigating them. Global instability. Given the US dollar's role as the world's reserve currency and the interconnectedness of global financial markets, any significant undermining of the Federal Reserve's independence can have international repercussions. It could lead to a less stable global financial environment, impact currency exchange rates, disrupt international trade, and reduce investor confidence in the stability of the global economic system. Addressing challenges to central bank independence requires a multifaceted approach, focusing on strengthening legal frameworks, enhancing transparency, fostering accountability, and promoting public understanding. Reinforce legal and institutional protections. The foundation of central bank independence lies in robust legal mandates. Laws should clearly define the central bank's objectives, typically price stability and maximum employment, and grant it the operational independence to achieve these goals without political interference. This includes safeguarding the tenure of central bank governors and board members, ensuring they cannot be removed for policy disagreements. Enhance transparency and communication. While independent, central banks must also be accountable to the public. This can be achieved through clear communication, regularly explaining policy decisions, economic outlooks, and the rationale behind actions in an accessible manner helps build public trust and understanding. Timely reporting. Publishing meeting minutes, economic forecasts, and annual reports allows for public scrutiny and demonstrates adherence to mandated goals. Testimony to legislative bodies. Regular appearances before elected officials provide a formal mechanism for accountability and explanation. Foster public and political understanding. A strong public consensus supporting central bank independence is a powerful defense against political pressure. This involves economic education. Promoting greater economic literacy among the general public and policymakers helps them understand the benefits of independent monetary policy, particularly in controlling inflation and fostering long-term stability. Resisting mandate creep. Central banks should focus on their core mandates of price stability and employment, and avoid taking on additional responsibilities that could draw them into political debates or dilute their focus. Promote fiscal prudence. Governments can support central bank independence by exercising fiscal prudence. Sustainable fiscal policies reduce the temptation for governments to pressure the central bank into monetizing debt or keeping interest rates artificially low to finance excessive spending. This reduces the risk of fiscal dominance, where monetary policy becomes subservient to fiscal needs, leading to inflation. By implementing these solutions, countries can work towards preserving the integrity and effectiveness of their central banks, which is crucial for maintaining macroeconomic stability and fostering sustainable economic growth.